For starters, the big ticket item this week was that Fed meeting. And the Fed stands for Federal Reserve, and they're in charge of keeping unemployment low and also maintaining the rising cost of goods and services and keeping it within a range of affordability for the average consumer. And this week, we heard them unanimously vote to increase the Fed funds rate, which is the rate that banks borrow from the US government to then loan out for things like auto loans, HELOCs, credit cards, and eventually mortgages. Now, many people mistake the Fed funds rate for what's happening with mortgages. And while they're connected, typically mortgages will trade in anticipation of what the Fed will do. And many people expected this Fed rate hike, 2 weeks ago. So we saw price worsen back then. And we've really been teeter-tottering between, latest inflation information with latest employment information. We weren't too surprised, and we didn't see a big market reaction, at least in terms of mortgages, with this news. Now, what's interesting about this is the Fed typically uses two inflation reports, the PCE and the CPI, to gauge where inflation is. And both of those reports use lagging housing data as one of the markers. And so because we saw a peak in rents and a peak in home prices last June, we should see decline in inflation from June to the rest of the year. We have seen that pattern happen the last two reports. My professional opinion is that that will continue to happen. And inflation is the primary concern, so the rapid cost of goods and services, right, for the Fed. And so when we get good inflation numbers, you should see that mortgage interest will decline. Because the Fed is in charge of inflation and employment, one of the weirdest things that is happening right now with all of the pressure that the Fed has put on borrowing costs is that unemployment is still basically the lowest it's been. In fact, we're at full employment for the country, which is anything below 5%. And so because we haven't seen an increase in unemployment, there is still very much concerns that the economy isn't slowing down enough for a big correction. So the biggest ticket item this week had to do with the Fed meeting, and the Federal Reserve is responsible for maintaining low unemployment and maintaining a reasonable growth of the economy, which is known as inflation. So that's the rising cost of goods and services. And their job is to make sure that things are affordable for the average consumer. And during COVID, the costs of goods actually rose beyond people's affordability. And when that happens, the economy is in jeopardy of a correction. And because the Fed is trying to get ahead of that, they use measures like increasing the Fed funds rate, which is the rate that, businesses and banks borrow from the federal government to loan out for things like auto loans, credit cards, lines of credit, and mortgages, more expensive. When they do that, goods and services become gradually more expensive, less people can afford them, demand drops, there's an oversupply, and then prices go down. And so they've been doing this now for over a year, trying to correct the rapid growth of the economy. What's interesting is our economy seems to be insanely resilient. We just haven't seen the slowdown that they were expecting. And so the biggest thing that we watch right now as it relates to mortgage interest rates has to do with inflation. Now, one of the things that a lot of consumers and a lot of real estate professionals get wrong is that the Fed funds rate directly impacts mortgage interest rates. Mortgage interest rates are actually impacted by mortgage-backed securities, which is pooled mortgages that are sold in the secondary market by investors or purchased by investors or hedge funds. And so they trade in anticipation of when the economic reports come out for unemployment or for inflation. There's a lot of economist predictions on whether or not the Fed will respond. And that's what typically has been moving mortgage interest rates. No one was surprised by the 25 basis point increase to the Fed funds rate, but it didn't impact interest rates that day. So it impacted interest rates about a week ago, right, when we started seeing analysts' speculation and Fed chairs start talking about what they planned on doing. So just know that yes, they are connected, but it's not like, okay, I'm raising the Fed funds rate and boom, now interest rates are up. Now, things that do move the mortgage-backed security market that are important for you guys to know is anytime there is an inflation report, so anything that shows that inflation is going down, historically in this market, right, this short-term marketplace has brought interest rates down. And when we see unemployment go up, right, we see interest rates come down. Now, when we see unemployment claims go down, right, interest rates go up. And when we see new job creations exceed expectations, we see interest rates go up. So positive employment news means that mortgage interest rates are not going to do great. Higher than expected inflation rates also mean that mortgage interest rates are going to go up. So when you are buying a home, believe it or not, you're kind of rooting against the economy and rooting for unemployment. So now knowing all of that, you can track the inflation reports that come out, or at least track like what the headlines are for the CPI report, which is the Consumer Price Index, and the PCE report, which is the Personal Consumption Expenditures. Both of those are inflation reports that the Fed uses to gauge if the economy is still growing, if the cost of goods and services are still outpacing affordability. This past Friday, we saw the PCE numbers come out, and just like the CPI report, it showed a decline. Now, the reason that it is showing a decline, in my professional opinion, is because housing makes up a very large percentage of the overall equation, and they're really doing like a phone survey where they call people and they're like, what are you paying for rent today? And the reason for that is that rents peaked, as well as real estate prices peaked June of last year. And so we have seen rental prices go down. We've seen the rapid increase in appreciation go down since last year. And so because housing is a lagging indicator in these reports, we should and expect to see inflation declining. Now, on the other hand, the other major item that the Fed pays attention to is employment. Now, on a monthly basis, there are the jobs creation report that comes out and jobless claims that come out. And all of this is provided by the Bureau of Labor and Statistics. Now, there's some other ones that come out like ADP, which is like a major payroll company for the country. They release some, and those can move the market. But generally speaking, they're keeping track of how many people are claiming for unemployment, how many new people are claiming for unemployment, how many new jobs have been created, and they gauge on a monthly basis and throw out estimates. And so if these numbers fall in line with where estimates are, people are super happy, right? Again, mortgages trade in anticipation of, so whenever they make a prediction, that's when we see movements in our market. And then if things are a miss, right? So if they're missed for the worst, like inflation is worse than, anticipated, or unemployment is way under what people anticipate, we will see a movement that day. But generally speaking, we trade in anticipation of, and as of late, a lot of these numbers have actually been under expectations. So we've had lower than expected inflation, which has been beneficial for mortgage interest rates. And so if anything catches analysts off guard, those are the big market movers. As somebody who's had to pay a lot of attention to this, a market mover, right? If anything catches us off guard in a bad way, it can move interest rates 0.5% in one day. I've seen interest rates increase over 1% in 1 week. So as somebody who is advising clients on a day-to-day basis about their home loan, if you're under contract, I say don't mess with the market. Lock when you are comfortable with that payment. It does not pay to roll the dice. Like, I think I've seen more people be pissed off because they were hoping for positive news and then got super blindsided. I think that generally speaking now we have a pretty good gauge on what inflation will do, but I think unemployment has now become the wild card. You would think with all of this pressure in terms of price and lower sales that we would see larger unemployment, and we just haven't. The surprising thing is that consumers are willing to go further and further into debt to still keep up with spending. And I don't know when that changes. I think, in my personal opinion, because we are now heading into the months where spending is the highest because people start paying money for gifts for the holidays and they start, traveling for the holidays to see family members and vacation, that we're just gonna see this tug of war with 7% interest rates until 2024. I think that the next like real big decline in the economy probably comes after first quarter, probably beginning of second quarter of 2024, when we really start seeing significant declines. And that's generally speaking the amount of time that it does take to move the economy with Fed interventions. Like if you're comparing it to how long it took to drop interest rates, how long it took to increase them, how long they did quantitative easing back in the Great Recession. I mean, generally speaking, the economy does not move quickly. I think beginning of second quarter next year is probably a pretty good time frame to start seeing interest rates really move down in a more consistent way. That's my best estimation, guys, for where interest rates are headed. I'd love to answer any and all questions you guys have in the comments below. And guys, if you found this video helpful, don't forget to like, comment, and subscribe, and share this on with a friend or family member.